Infrastructure returns had a strong absolute quarter, although they did underperform general equities, which benefited from this large monetary and fiscal easing that we're seeing globally at the moment. That's not surprising because in past periods, when infrastructure has underperformed in relative terms, it has been when equity markets have been very strong. And we've also seen that underperformance close up quite quickly. That's a function of those really attractive characteristics that we see in infrastructure, which is so sought after in almost any economic environment, but certainly in this environment where we have low growth, low inflation, and low interest rates. Fortunately, there is no lasting impact from COVID-19 on the asset class or the cash flows of the businesses we invest in. For the main part of our portfolio, being utilities, the impact has been negligible. And think about it, they're essential services. So they provide water, gas, and electricity to the broader population and to industrial and commercial users. So they have very low elasticity of demand. So even events like COVID don't really impact their cash flows. And when they do impact, there is systems and regulation to allow them to claw back that impact. Most importantly, what we've seen at the national level across the globe is a renewed emphasis and push for infrastructure spend. Governments see infrastructure spend as an easy way to stimulate their economies. North American renewable utilities were the main contributors to performance in the quarter. Companies like Mixteria Energy, Brookfield Energy Partners, and Clearway Energy all had very strong returns. They're all benefiting from this strong tailwind of increased renewable energy use in the overall energy mix. More specifically, each company has really strong competitive advantages, an international portfolio of assets, and very strong capital allocation, which is very important in this sector. So we really think that performance will continue to be very solid over the next few quarters. The two key areas that detracted from portfolio returns in the quarter were one, a Chilean water company called Aguas Andinas. It operates the water distribution network in Santiago, Chile. During the quarter, we saw some COVID-related impacts to demand emerge, and Chile at the same time is experiencing its worst drought on record. So the cost of purchasing water has gradually increased over the last year. What's important to note though, is that both those impacts will be clawed back through regulation. So there'll be no lasting impact to operating cash flow. The second area, which was a bit challenged during the quarter, was UK utilities. And some of those utilities are in the middle of a regulatory reset. And we have seen in the past that when companies are transitioning to a new period of regulation, there is a bit of underperformance. But again, we don't think that underperformance is permanent. And we see, strong times ahead for both those companies. As it relates to risk, we think about risk in two buckets. One is company-specific risk, and the second is more general market risk. Company-specific risk that we focus on, regulation, operating performance, asset-based growth, those risks we're very comfortable about on a 6 to 12 month view. We don't see any issues arising. The more general risks that we think about and focus on, interest rate risk, growth risk, inflation risk, and obviously election risk, that's a bit different. As it relates to those risks, the two which we think are most uncertain are the election risk and the growth risk. And fortunately for infrastructure, those two issues don't really impact the outcome of asset-based growth and long-term drivers of the sector. We're quite indifferent about who wins the various elections around the world. And as it relates to growth, as I mentioned earlier, infrastructure is an essential service and it has very low elasticity to demand or growth outcomes. So in any growth environment, the assets do very well.